Warm welcome to all of you. This is A.K. Aslani from Smart VRC Bhopal, and today's webinar number is 98. Yes, during last 1 year, a little more than 1 year, we have completed 97 webinars, and today's is the 98th. Thank you all of you for your constant support. Yes, we are celebrating, Smart VRC is celebrating the 21st year. We have completed 21st year. So today's topic is natural investing secrets. Rather, I should say, there's no more a secret, but even after knowing these natural instincts, we are not using it. Majority of the investors are not using it. So starting with a poll, I'm investing from last more than 20 years and my returns are more than 15% CAGR. So on your screen, you can choose your option. I'm investing from last more than 20 years and my returns are more than 15% compound. Yes or no? In another 10 seconds, voting will stop. I request all of you to participate. So the results are very interesting. As the 80-20 rule says, it is more than 20. It is 23% say that yes, and 86% say no. And let me tell you, we are all here who believe in long-term investing. I hope so. Maybe about 3-4%, maybe the investors or the traders who are investing for short term. But most of us are from long-term investment point of view in this webinar. And still 86% of the investors are not able to generate more than 15% CAGR or may not be investing from last more than 20 years. Yes, this is a fact. I thank all of you for giving the honest answers. This is the ratio, and that is why the natural instincts play more important role in generating returns. So what we are going to cover in this presentation is basically what are the natural traits, characteristics required for success in stock market, and how to acquire these traits, and what are the kinds of investors based on natural characteristics, based on nature, who are investing based on natural play, rather I should say that. So here we go with a very small but very interesting video. So you must have observed many things, and I'm very sure you must have missed some others. There are it was a very long list of natural traits which can be learned from these three videos. And let me see how you respond to this poll. The most important factor in success in all these three videos are patience, determination, guidance, calmness, or all of above. So let's see. So poll is in progress. You can answer. The most important factor in success. Is it patience, determination, guidance, calmness, or all of the above? So still only 70% participants have answered. I request all of you to participate. Only 5 seconds left. Okay. Here is the answer on your screen. 18% say it's patience, 14% say it is determination, 4% say it is guidance, 6% calmness, and 76% all of them. Right? Yes, patience and determination are more important. Of course, guidance and calmness have their own role. So in a way, we can say that all of these are important. And let's see what we do when we invest. So successful investing is about managing risk, not avoiding it. This is said by Benjamin Graham. In one of the videos, rather in the second video, you must have observed that a little girl, she was wearing some soft pads on her ankle and on her hands. And that was because if she falls down, then there has to be some support, there has to be some safety measure. And that was the case with all the three videos, in fact, because even in the first video, she knew that the height is not much and she was wearing shoes. So there was a safety element there also. And that is why Benjamin Graham says that successful investing is about managing risk, not avoiding it. You cannot avoid. As I keep saying that if you have to succeed in stock investments, then you must learn how to dance with fear. Dance with fear means how to manage risk. In a similar fashion, during last about 1 month, rather 1.5 months, sensitive index has reached to about 52,000, little more than 52,000, and now it is below 50,000. So it is below, it is about 4% down from the historic high. But smart billionaire picks is standing at historic high. Its value is 99.13 lakhs. It is the historic high. How? That is how we are managing the risk. You have to manage your risk and return, expected returns in such a way that your portfolio is capable of not only reducing the risk, but also gaining when the market rises. So you have to select the stocks like that. It has to be a mixture. You need to have some stocks in your portfolio with a very low beta. Rather, I should say very strong fundamentals. I'm not saying that the stock should be overpriced. Stock should always be underpriced. Underpriced means below the intrinsic worth, but it should have very strong fundamentals so that if the market falls, that stock will not fall. There are many examples I can provide, and those who are our subscribers, they know very well how we are managing smart billionaire picks. Of course, we are getting only one chance in a week, that too before 11 a.m. But still, we have managed to record huge 26.02% CAGR returns during last little less than 20 years. Yes. So that is all about the risk. Nature is our greatest teacher. We all agree. And this teacher has given us everything in plenty and has now understood that human beings do not understand its value. Nature has its own ways to teach people and make them aware of its importance. And the same holds good for stock market. BSE sensitive index has given us returns of more than 15% CAGR since 1979. For so many long 41 years, it has given us returns of more than 15% CAGR. And as you have seen the results in the poll, investors are not able to even remain in the market for 20 long years, leave apart the returns generated of more than the market returns. So even in a passive way, even in a natural way, if investor has invested in Sensex or index fund, he could have generated 16% returns in a natural way, in a passive way. But becoming more active, he loses. That we have seen in most of the cases. As I have been discussing that there is the same amount of returns in the long run, there is 15%, and there is for all. And these returns could have been easily gained, could have been easily achieved by investing in the index. And it is not that these returns are linear. For example, during last 1 year, we have got about more than 90% returns in Sensex, but average CAGR returns are 15%. So it is in the short term that more in some years leading to flood of returns and less in some years leading to a drought. In some of years, we don't get any returns. In fact, we get negative returns, but in some of the years, we get more returns. So natural return is 15%. If you're investing in index, then it is 15%, but not linear. So if you want to get extra natural returns, then you need to have extra traits, extra natural traits than the index. What are those traits? The trade is, if the stock is underpriced, you have to buy more of it. And if the stock is overpriced, then you have to sell. You have to make an exit. This action should be natural. It should come naturally, not artificially. But in most of the cases, what happens when the market keeps on rising, then the investor enters, or rather investor starts investing more during those times because the market is rising, not because the stock is underpriced. So your natural action should be when the stock is underpriced, then only you should invest more, or when the stock is overpriced, you should exit. That is the natural, rather I should say that is the extra natural way of creating more returns than the market. Now, while driving a car on a highway, you must have observed that it often happens when the road is clear, when you come out of the crowded area and the road is very clear and vision is very clear and good quality road, you are driving on a good quality road, automatically your accelerator increases, the pressure on your accelerator rises and your car starts flying at a fast speed, moving at a fast speed. It is natural. You must have observed many a times when you look at the speedometer and you find, oh, speed is 140 kilometers per hour, 120 kilometers per hour. So that has come naturally. That should be the case with stock investing also. If more and more stocks are becoming underpriced, you should find it difficult where to invest. But in general, what happens is when the market keeps on rising, investors' watch list keeps on increasing. It should be the other way. When the market is down, when the many stocks are available at price is much below the intrinsic value, that is the time when your watch list should be long enough. But it is the other way, most of the cases. As you can see, this is the chart from 1st of April 1979 till date, and there are many ups and downs. It is not a market is not giving you natural returns all the time. Natural returns are 15%, but many times it becomes overpriced, many times it becomes underpriced, and along with the market, many stocks move in the same fashion, means underpriced and overpriced. So what are the steps to natural investing success? First is the perseverance. Perseverance means you have to win. Unless you win, you will keep on investing, you will keep on investing, trying different methods, trying different ways. That is perseverance. Then is the determination. Yes, as you have seen in the video, all the three characters were strongly determined to win. They were determined that they have to reach to the destination, be it the first case, the second case, the third case. So determination is very much required, but determination alone is not sufficient. You need to have a strong perseverance. Now comes the motivation. What is the motivation? So in the first case, the motivation was maybe the parents were standing the other side of the camera and they were watching that kid and that little girl that decided that, yes, I have to reach to the top of the horse. Same was in the second case. Second case, it was a little different. Motivation was that her brother was already on the top of the horse and she wanted to enjoy the ride. That was the motivation. So you need to be, and in our case as an investor, we all are motivated by the money we want to make in the stock market, the wealth we want to create in the stock market. That is the motivation. We want to create wealth because we have some financial dreams in our lives and we want to fulfill it. Safety measures, as we have already discussed, in all the three cases, there need to be some sort of safety measure, and the same applies to the investors. We should always think of, if the market falls from this level, which are the stocks which will provide the greatest safety to my portfolio. They should act as a very strong shock absorber. They should not let your portfolio to go down substantially. So you need to structure your portfolio in such a way. You need to have the stocks which will provide which will absorb the shock. Then comes the learning. In all the three cases, you must have observed that how these creatures, the little girl in first case, in the second case also, and the third case, a little dog, they were learning all the time. If this process is not successful, then they were trying some other process, then the third process, then the fourth process, but they were always learning. It was not like that if they are applying a certain process, and if they are not successful and they keep on applying the same process, then there is no use. Every time they are failing. But in investment, it happens often that investor, if he is applying some technique, and if he is not successful, he keeps on applying. There is no use. If you are not successful this technique, you leave this technique, apply another technique. Look for the investors who have created huge wealth, what technique they have used and what they are doing. Try to take help from their success. So you have to keep learning through the books, keep learning from your own mistakes, keep learning from your own successes also. All these three videos, whatever they have shown, they were focused on the process. They were very much focused how to succeed. Okay. Often what happens in case of investors, they are focused on the price, how much up it has gone, how much up it has gone. We need not have to focus on the price of the stock. We have to focus on the process of selecting the stock, on the process of developing the story. What is the future? That our focus should be on future, not on the present share price. Present share price only gives you an opportunity to add more. That's all. In the second case, you must have observed that her brother was at the top of the horse and he helped his sister, and that is the helping hand required in case your targets are very high, in case you are not successful despite repeated attempts. So you need a helping hand. If that is required, there is no harm in hiring an advisor. You can always hire an advisor, but at the same time, you must know his capabilities. In the second video, you must have observed that how her brother shifted from the back position to the front. He was always looking at the risks involved. He was very careful. So that should be the kind of investors we must look for. He must not only give us the helping hand, but he must also have the experience. So we will continue further, and we also have prepared some videos on this topic, how to succeed naturally, and we have given lots of our own experience in this market. We have captured that in small videos. Let's have a look about this product, that is Smart Insights Pro. Well, this was all about Smart Insights Pro. And as you may be aware, we have our own WhatsApp groups based on city-wise. Those who are new to this webinar and they want this information about the webinars and also about the small, good enlightening articles about the stock investments, about the success in the stock investments, they can send us a request on this number. This is our WhatsApp number, and kindly send your request along with your name and city. The number is 9755920780. So let's continue with the steps to natural investing success. So this we have covered: perseverance, determination, motivation, safety measures, learning, focused on the process, advisor, and then play stocks naturally. We have already covered how to play naturally. Naturally means whenever the stock is at least 20% below the intrinsic worth, then it's time to buy. And as the stock price starts moving beyond the intrinsic worth, start offloading the stock in phases, not in one go, because stock market is a place where the price goes much beyond in both the ways, upside as well as the downside of the intrinsic value. So while booking profit also, you should not hurry, but while booking a loss, it is very natural that you should hurry. So the next is confidence of the coach. This we have already seen. And the confidence of the coach alone does not matter. What matters is how much is the experience of the coach. Confidence can be an overconfidence also, but the real confidence can be measured only with the experience. As we have seen and discussed in this second video, how the boy, the brother of that little girl, how he shifted from back to the front position. That shows the experience, that shows his mastery in his area. Comfort level of investor with coach, that is also very much important, because if you are not on the same page, then maybe investor is using some other technique, but coach is advising you based on some other technique. He is totally different. Then also investor will not be in comfort level with the coach. So either he should change the coach or he should try to study himself that whether he is right or his coach technique is right. So it all depends. It takes some time to understand what kind of technique suits you. So it depends on the individual to individual basis. Then is the patience. Yes, patience is very much required. Even if you have done your homework, it may take a very, very long time for the stock to reach to your target, or rather I should say to go beyond the intrinsic worth. Patience is very much required. Of course, merely buying a stock without any research, without any proper analysis, and then holding it patiently will not do anything. There are a lot many stocks which have fallen down. Reliance Power, Reliance Capital, Yes Bank. There are many. List is very, very long, that despite you are holding it from so long time, and then you say that I have held it for so many years, I have shown so much of patience, yet I am not getting returns. This will not work. Stock should be right. Then only the patience works in your favor. Right? And try different ways that we have already discussed in the video that you have seen. If some technique is not working, try for some other way. If that also is not working, try for some other way. Maybe you have some natural instinct which you may find over a period of time what works for you. If you are very good at flying kites, then you can make analogy with that. If you are very good at playing chess, then you are You can draw analogy with your portfolio of 16 stocks and the kind of stocks. That is the way to find some natural instincts. Hardly 1% investors amass a huge wealth, we all know very well. And some investors are naturally irrational. I should not say some, but majority. By birth, we are very natural. We do the things very naturally. But as we grow, and so are the irrational things happen. So when I say irrational, irrational means mainly the emotions of greed and fear. These are natural. Natural means being in the society, we develop these things. So, and there are some investors who don't care about the market. What they do is they simply invest in some index fund and then sit quietly because they have the confidence in the market and they know very well that they cannot outperform the market. So they don't care. And that is a class of investors mostly in mutual funds. And then we have artificially intelligent investors. Artificially intelligent means they have been able to remove the irrationality from their nature artificially. Initially, it is artificially, but over a period of time, it becomes natural. So you have to be naturally intelligent. Ultimately, the winners are those who are naturally intelligent. That is what I was saying. Smart word, the natural born investor is a myth. Yes, as I said, this is a quote from Peter Lynch. As I said, by birth, one cannot be a natural investor because of the greed and fear we develop as we grow. And we have to manage this greed and fear. So with this, we have come to the end of the presentation. After this presentation, participants are requested to write their questions in the chat box, or even they can raise their hands and I shall ask you to unmute yourself. Thank you very much for your kind patience and sparing your valuable time. Mr. Sainath, kindly unmute yourself.
Yeah.
Sir.
Good afternoon, sir. Good afternoon, sir.
Good afternoon, sir.
Sir, one question I would like to ask, one technical question, is to find the intrinsic value.
Yeah.
To find the intrinsic value,
yeah.
This PEG ratio formula, PEG ratio, will do, sir, to find the intrinsic value of the stock.
See, in stocks, there are two categories. One is the value stock, the other is growth stock. For growth stock, PEG is very well, and we are using from last so many years, not from so many years, from last more than 20 years.
Sir. Sir, could not able to hear, sir, properly.
Okay.
Up to the growth stock, I was able to hear. After I am not able to, sir, hear you.
Okay.
Yeah.
There are two categories of stocks: value stocks and
growth stocks. Growth stocks. Okay.
PEG is for valuing the growth stocks.
Okay. Growth stocks. Okay.
Yeah. In value stocks, you cannot use PEG, but for growth stocks, PEG works very well.
Okay. Okay, sir. To value stocks, to know the intrinsic value, is there any formula such as a PEG ratio, sir, for growth stocks?
No, there is not a formula, but it is very difficult. And value means, suppose if there is a textile mill in Mumbai, and if it is 100 acres of land very near to Mumbai, then it is a value.
Okay.
Maybe its performance from the textile operation is not that good, but the land. So you need to find out the value of that land. It is very difficult.
Okay. Yeah.
Mr. Viral.
Sir, good afternoon.
Good afternoon, sir.
Sir, I have two questions. First question is, can we have a calendar year-wise or a financial year-wise return of our smart portfolio, smart billionaire picks? Just to dig deeper, as how it is fared well against the index each year, though it has outperformed in the last 20 years. But just to compare, is it possible?
Yeah, it is available on our website. And moreover, very soon it is going to touch 100 lakhs. So we are going to have a webinar and I will show you each and everything performance of Smart Billionaire Picks since the day one. Also, that year-wise performance is available on our website.
Okay, sir. Okay, I will do that. And second question is, what do you think about the commodity stocks which have run up in the last 3-4 months, like the stocks like Tata Steel, JSW Steel? We haven't invested in any of them, but it has done well in last 3-4 months. So do you think that the commodity cycle is going to happen in next 2-3 years?
It is like this. Commodity cycle, predicting a commodity cycle is very, very difficult. And even Tata Steel, what the share price level you are seeing has been achieved after, I think, 9 or 10 years. So during these 9-10 years, if you have purchased Tata Steel, then it was a long, long wait. And there is one more factor to it, because this is steel or copper prices or aluminum prices, these are dictated at international level. And predicting the international cycle is really very difficult. And moreover, China is taking some unusual steps, especially in case of steel. It is very much concerned about the pollution. So it is not only the demand pickup, means it is not only the natural demand pickup, but also because of the Chinese policies, and that those policies one cannot predict. Why commodity stocks are rising? It is very simple. Lots of stimulus has been poured in by almost all the countries around the globe, and this excess money is creating a demand. So how long this demand will remain there, or how long stimulus will be provided, if you are able to predict that, then you can predict the commodity cycle also. But it is really very difficult to predict. And if you are investing in any commodity stocks, then be very careful and use the stop loss very strictly. We are a bit hesitant. Of course, we have recommended a steel stock, but we are not going to be very, we are not going to recommend very strongly in this sector. That I can see. Mr. Vikas Dureja?
Yes, Asnani, sir. Good morning.
Sir, good morning, sir.
Sir, what I want to know is that how do you see the future of investing in India? When I say this, we come across various articles that the future investing is going to be algo-based or artificial intelligence-based, and it won't be any any human intervention will be minimal, and what we call a 100% passive investment. And the trend to some extent is evolving in developed markets like NASDAQ or US. On the other hand, we always say that that investing definitely has an art component of it. It's not 100% science or logic or mathematics, but it has a art component in it, the investing. So with these new trends coming up, algo and artificial intelligence based, almost nil human intervention. So how the future is going to be in next 10 years as per your understanding?
Okay. Warren Buffett is investing from last, I believe, 70 years. And he has seen many different type of investments and different type of techniques being used in stock market. Until date, he has been successful, and he is using only one technique: find the intrinsic worth of the stock. And this is the ultimate thing. No algo can find out the intrinsic worth of the stock because it involves quantitative as well as qualitative techniques. So, and if you say that investors will not be investing or will be through algo, then from where will come the factor of greed, the factor of fear? If there is no fear and no greed, then market will be stable. Who will dictate? Who will move the market? Algos alone cannot move. Until and unless the investor is not involved, market cannot move up and down. It happens with me also. I am investing since 1989, and lots of time it happens that the young investors, they come and they say that, what I mean to say is not in the physically this thing. On WhatsApp groups, I have faced many a times challenge that they say that, uncle, your time has gone. Now the things have changed. New techniques have come, and now your technique will not work. But I'm still there, and we are making 26% CAGR returns. So there is no need. I am not at all fearful that algo will come. Algo cannot do the thing which I am doing it. That is what I would like to say. And lot many investors, other investors are also there. Rakesh Jhunjhunwala ji is there, Vijay Kedia ji is there. They are all investing from last so many years, and they are investing based on the real, on finding the worth of the stock, or finding the way they are using the same techniques, and still they are able to make money from last so many years, and there is no reason they should not make, or something like that. Yeah, any other query? Today's session was pretty simple, and stock creating wealth is simple. We are only making it complicated, and it is as simple as what I have shown you the videos, and these are very much in resemblance with my own investment experience, and I'm very sure there are other investors also here which have more experience than me, and they will also agree. And as I can see the names, there are many investors who have more experience than me. So with this, we come to the end of today's presentation. Thank you very much. Enjoy your weekends. Bye-bye.